A lot of people are talking about recessions today. One of the most common questions we get is, what is a recession? I think a lot of economists and financial advisors even disagree on what a recession is. So Josh, is it 2 quarters? Is it the market going down? What makes a recession?
So there's a couple different definitions of a recession. The most commonly quoted one is 2 negative quarters of real GDP growth. So right now we may be in a recession. The first quarter of this year we did have a negative real GDP number. We don't know the second quarter yet. We're about 7 or 8 days outside of that, so we'll start to get that data. There's a chance that we're actually in a recession right now, because if we're growing at 6%, inflation's 8%, that's technically a minus 2% GDP.
Recession is a very scary word to a lot of people. A lot of people think that recessions make the stock market go down, or the stock market going down causes a recession. Can you talk about recessions and stock markets and how they react to each other?
So we've had about 7 recessions in the last 50 years. We actually had one during COVID, very briefly, one of the shortest recessions in history. I think when people hear the word recession, they think a lot about the 2008-2009 financial crisis, which was, by historical standards, a really bad recession, really bad period for the stock market. But historically, we have recessions pretty frequently. They all look different. The causes are different, and how deep and severe they are is all different as well. So it's hard to cast a broad paintbrush on recessions. But typically the stock market goes down around 30%, and we're down roughly 20% right now. So the stock market is already kind of priced in maybe a mild recession at this point. So it could go lower if the recession starts to look really bad. But right now it seems like the market's pretty fairly priced in what's going on today.
What about timing? Does the market go down before a recession? Does the market stay down until the recession's over? Does the market mean anything?
The market's always looking so far ahead. So the stock market will go down before the real economy goes down, which has already happened. And the stock market will rebound typically before the economy rebounds. So if you try to use recessions as a timing indicator, it's not going to work. So there's a lot of data on recessions and how the stock market's performed historically. One of my favorite sayings is that economic summers are way longer than economic winters in the United States, and that's historically been true. And recessionary times have not always been the worst time for investors. The average return that you get the first year of recession is actually minus 1%, with a great rebound typically the next year. So recessions are not great, but they're also not a reason to panic and abandon your long-term investment plan.
What about length of market downturns? Are we in a normal downturn, a long one, short one?
Some recessions are longer than others. Some last a very brief amount of time. Others are years. And same with stock market corrections. Sometimes the market rebounds quickly. Other times, say the tech bubble in the early 2000s, it took several years for the market to find a bottom. Some of the supply chain issues we hope are temporary, but people have been saying that for months. And I think what has happened is we've realized during COVID, we didn't just put our foot on the brake and slow down the economy. If you're riding a bike, we kind of just put a stick in the spoke of the wheel and everything ground to a halt. And when you try to restart things with supply chains that are so tight and built to be very, very close from a delivery date to an order date, we've realized that you can't just slam on the brakes and stop altogether and then restart smoothly. So I think we're just going to have months of issues as it's different ports and different materials and microchips. As all those come back online, I think it's just going to take time for supply chains to heal themselves. Additionally, China's COVID-0 policy has caused a lot of issues because a lot of things that we buy come through Chinese ports. And when they are locking down entire cities, it's trouble for the supply chain. But hopefully that gets better because China is relaxing their COVID-0 a little bit, reopening a fair amount over the last couple of weeks. So things are headed in the right direction on that front. So a lot of the downturn in the markets has been things that to us didn't make a lot of sense to begin with. So really high values for cryptocurrencies, people using cryptocurrency exchanges to even leverage their holdings. So they're taking something that's already risky and speculative, and then they're adding layers of leverage on top of it So you're seeing a lot of bankruptcies with hedge funds that focus on cryptocurrencies or exchanges that focus on that. That was something that we've been skeptical on for a long time. And so this makes sense to us that that is coming down to earth. Same with growth stock valuations. So parts of the market got way too frothy. For a long time, Zoom Technologies, the video conferencing system, was trading at higher valuations than ExxonMobil, which Exxon is a huge player in the global energy infrastructure. They actually make things very important. But people just got way too excited about some of the growthier areas of the market. And we have a lot less of that in our portfolios than most people do. So we've benefited from having more boring, value-oriented dividend-paying stocks in the portfolio.
We've talked about darlings of COVID, Carvana, Peloton, other examples that got extremely high.
Great companies, really cool products, but share prices have just got way too ahead of themselves. Like you were saying, Brian, let's sell now and get back in when things look better. We hear that all the time. It sounds really intriguing to do that because you want to feel like you're doing something, you're taking action, you're stopping the pain. But what happens is you never know when to get back in. There's never a time where it starts to feel good, because what happens is the stock market turns around and starts performing really well before the news starts to change, because it anticipates it's not as bad as we think it is, and the market starts to come back. And so it's almost impossible to get back in before the market prices that.
To fight our own reflex. We're not hunter-gatherers. You don't want to do the fight or flight, run away from bad things.
Fight or flight is not good for investing. So it's tempting to try to come up with a forecast for the market. Everybody wants to know if the market's going to go down further from here. Impossible to know. It's very possible that it does, though. Going down another 5 or 10% is very feasible. If we get a couple more inflation numbers that look really high over the next couple months, I could easily see the market going down a little bit from here. But I do think that inflation will start to subside. The year-over-year comparisons themselves just get harder. So we've already reset inflation higher. And if we're measuring off of higher marks, it just gets a little easier to make inflation look less bad. Also, supply chains in theory should start to get better. And lastly, the midterm election. So strangely, midterm election years are usually not great for the stock market. They're one of the historical anomalies that we have, where during a midterm election cycle, the stock market can be a little bit volatile through the summer, but July, August, September roll around and the market starts to get back on track historically. So there could be some benefit and some tailwinds to the markets heading into late summer, early fall.
Yard sign season.
Yard sign season?
Yard sign season.
Okay.
It's the midterm elections.
Okay. Oh, there we go.
The yard signs.
Yeah.
So one of the most common questions we get is, can I still retire, or can I stay retired when my account's down, stock market goes down? How do we stick to the plan when markets are down?
In our view, you have to plan for this ahead of time. So I like to tell the story about being on an airplane and they're going through the safety demonstration and you've got your headphones on, you're either watching your movie or reading a book, you're not paying attention, right? And then you start to feel some turbulence during the flight. And you start to think, man, I wish I would have paid attention to that safety demonstration. I don't know where the exits are. Where is my oxygen mask? Do I have a flotation device? So you start to appreciate some of that guidance when times are scary. And so the time to prepare for that is ahead of time. So when we're crafting portfolios and financial plans, we plan for bad markets. We know that they're going to happen. They're inevitable. We don't know exactly when, but we don't ever want to have to tell our clients that they can't take that vacation or they can't retire. So we build in elements of conservatism and durability that think about these exact markets.
Okay, so we're not selling any client accounts. What are we doing?
We're doing the opposite. So we're buying. To the extent people have extra cash, we've been putting that to work. All of our clients own some actively managed funds. So every single day, somebody is making buys or sells on your behalf, trying to find the best positioned company. So there's a lot of activity going on right now. You don't always see that in a transaction confirmation, but there's a lot of activity in client portfolios right now. About a month ago, we did make some very targeted buys where we think the best valuations and opportunities are. So we took action in most client accounts about a month ago. And if markets go lower from here, we're prepared to make even more buys. We have some rainy day funds that are dry powder. So we'll put those to work if we do get that 30-ish% correction. So Brian, should people be worried right now?
It's normal to be worried. It's normal to have some fear. It's hard to unwire your brain from feeling a little bit of anxiety, but that's what people hired us to do. We're your partner, we're your guide. We're going to get through this just like we got through the last 10 crises. And so there's a plan. You need to stick to it. Pick up the phone and give us a call. We're happy to talk and remind people what that plan looks like.